Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden inside corporate reports. And today we've got Crane NXT Co, their latest annual report. Get ready because this filing might just spill the tea on some serious strategic moves and financial acrobatics. If you are looking to understand what is really going on behind the scenes in the industrial tech world, this is the video for you. Before we dive deep into the numbers and the risks, please make sure you are subscribed to the channel. We break down these filings so you don't have to, and if you want to connect with like-minded folks, join our Discord community linked in the description below. So what is the big story here? Crane NXT is a company focused on securing, detecting, and authenticating valuable assets for its clients. Think advanced micro-optics and sophisticated electronic equipment. They operate in two main areas: Crane Payment Innovations, or CPI, and Security and Authentication Technologies. ORSAT the last year seems to have been a period of significant growth and acquisition for them, which is always interesting to unpack. They talk about two main segments: Crane Payment Innovations, or CPI, which handles electronic equipment and software for transaction authentication and security and authentication technologies. ORSAT, which deals with physical product security like banknotes and also brand protection online. They recently renamed the Crane Currency segment to SAT after bringing in some new businesses like OPSEC and De La Rue. Their common stock trades on the New York Stock Exchange under the ticker symbol CXT as of January 2026. They had over 1,300 holders of record, which is a decent chunk of stakeholders keeping an eye on things. Now, every company has risks, and Crane NXT is no exception. They highlight macroeconomic fluctuations as a major concern, which is understandable given the global economic climate. Demand for their products is also described as variable, pointing to the fact that their fortunes are tied to very specific and sometimes unpredictable industries. They also call out the inherent risks of doing business outside the US, detailing potential issues with political instability, currency fluctuations, and trade policies. Cybersecurity is also front and center with them, acknowledging the constant threat of data breaches and system failures. And of course, acquisitions always come with risks like failing to integrate businesses or overpaying for them. They even mention the risks associated with their separation from Crane Company. They are taking cybersecurity seriously, investing in programs and training, but they admit their control over third-party vendors is limited. They haven't identified any material cyber threats yet, but it's a good reminder that in today's world, this is an ongoing battle. Looking at their physical footprint, they've got quite a few facilities spread across the US, Europe, and other international locations. They own about 13 manufacturing facilities and lease another 7. For non-manufacturing spaces, they own 7 and lease a hefty 42. This shows a significant physical presence supporting their global operations. This is where the rubber meets the road. Let's look at how they performed financially. Total net sales jumped by 11.4% to $1.656.7 million in 2025. This growth was significantly driven by acquisitions, contributing 8.9% to that increase. Core sales grew by a more modest 0.7%, and they benefited from favorable foreign currency translation as well. On the cost side of things, cost of sales went up by 16%, and selling, general and administrative expenses increased by 14%. This is largely due to the acquisitions they made. As a result, their total operating profit actually decreased by 8.2% to $246.7 million despite the higher sales. This tells a story we often see with major acquisitions. The buying company records higher sales, but the integration costs and the new business's initial performance dilute the overall profit margin initially. Let's break down the segments. The Crane Payment Innovation segment saw a slight sales dip of 3% to $846.6 million. This was mainly due to lower core sales in their vending business and some unfavorable mix. Service revenue did increase, driven by favorable pricing. Operating profit for this segment decreased by 3%. This segment seems to be facing some headwinds, but still holds strong operating margins around 26.2%. Now for the star of the show, the Security and Authentication Technologies segment. Sales here soared by a massive 32% to $810.1 million. A huge chunk of this growth came from acquisitions totaling $133 million, and another $41.8 million from higher core sales, primarily in their banknote business. However, operating profit for this segment decreased by 12.2%. Why the decrease in profit despite the sales surge? The report points to higher material and manufacturing costs, acquisition-related costs like amortization and restructuring charges associated with integrating De La Rue and OPSEC. This segment has the big growth story, but also the big integration challenges. Corporate expenses stayed relatively stable, increasing slightly by 2.6% to $72.3 million, mainly due to higher compensation and benefit costs. Interest expense went up by 26.2% to $60.3 million. This is a direct consequence of taking on more debt to fund those acquisitions. They also recorded an equity investment loss of $11.5 million related to their investment in Anteras Vision. Their effective tax rate was 19.8% in 2025. This is a bit higher than the previous year due to the mix of where their profits are being earned. They also noted a Pillar 2 tax liability of about $1.3 million in 2025. Looking at cash flows, cash provided by operating activities actually increased in 2025 to $241.5 million, thanks to better working capital management. However, investing activities used a lot more cash this year at $549 million compared to $318 million in 2024. This is primarily due to those major acquisitions like De La Rue and Anteras Vision. Financing activities saw a large inflow of $363.6 million in 2025, mostly from borrowing more money for those acquisitions. Total debt has ballooned to $1.139.5 million as of December 2025, up from $750.6 million in 2024. This is a pretty significant increase, showing their aggressive acquisition strategy. Their debt to capitalization ratio has also risen to nearly 48%. This signals a higher reliance on debt financing. The company is carrying more debt than equity with a net debt to equity ratio of 72.5%. This is a key figure to watch to see if they can manage this debt burden going forward. They recognize revenue when control of goods or services transfers to the customer. For government contracts, they recognize revenue over time using a cost-to-cost method. This is a common practice for long-term government projects. As of December 2025, they had over $1.1 billion in goodwill and $557.2 million in other intangible assets. Goodwill is the premium paid over the fair value of identifiable net assets in an acquisition. It's a big number here and it's subject to impairment tests annually. The acquisition of De La Rue and OPSEC significantly boosted these figures. They incurred restructuring charges of $16.8 million in 2025, primarily for severance costs related to integrating De La Rue and OPSEC and to align costs in their CPI segment. Their auditors Deloitte and Touch LLP gave them a clean opinion on their financial statements. However, they did flag revenue recognition on US government contracts as a critical audit matter, requiring significant judgment from management, specifically the estimation of margins on these long-term contracts. Let's glance at the bottom line. Net income attributable to common shareholders was $145.1 million in 2025, down from $184.1 million in 2024. This is consistent with the overall decrease in operating profit we saw due to acquisition costs and integration. Earnings per S-Hair also saw a dip. Diluted earnings per S-Hair were 2.50 in 2025 compared to 3.19 in 2024. This is a pretty clear drop though, not catastrophic by any means. Looking at the balance sheet, total assets have grown significantly to $3.1 billion, up from $2.3 billion. This growth is largely driven by those acquisitions adding substantial assets. Total liabilities also increased as expected with the higher debt levels. Equity also saw an increase driven by retained earnings and other comprehensive income. When we look at this report as a whole, Crane NXT is clearly on a growth trajectory through acquisitions. The SAT segment is showing impressive sales expansion driven by new businesses contributing significantly to revenue. However, this rapid growth comes at a cost impacting profitability in the short term due to integration expenses, higher operating costs, and increased debt. The company is leveraging debt strategically to fund its expansion, which has increased its financial risk as seen in the higher debt to capitalization ratio. Management's focus on proprietary technology and strategic acquisitions seems sound, but the challenge will be to effectively integrate these new businesses and translate that top-line growth into sustainable bottom-line improvements without overly straining their finances. The company is banking on its ability to manage this growth phase effectively. They appear to be navigating a complex landscape of market demands and financial leverage. We will be watching closely to see if their integration strategies pay off, and if they can successfully turn these acquired assets into long-term profit drivers. That is our dive into Crane NXT's latest annual filing. What is your take on their acquisition strategy and its impact on their financials? Do you think they are on the right track? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for more real-time discussions. Thanks for watching, and we'll see you in the next Decode.